when you talk about, scaling alternatives, obviously, they're saying out there that private markets are broken. There's a lot of friction throughout the investment cycle. Why is there so much friction, and what can family offices, do to eliminate some of that friction?
Well, I wouldn't agree that private markets are broken. I think if you go to the macro, the obvious is that the number of publicly listed companies in America has declined significantly, maybe 80% over the last 10, 15 years. And the number of private companies has increased significantly. In fact, the number of private companies that have $100 million of revenue or more has grown substantially. So if you want to participate in the economy with your investments, and you're not in private markets, you're missing out on a large part of the economic viability of the country or the globe, for that matter. So why have they been messy? Well, these have always been paper-based private investments with a lot of disclaimers and a lot of legality. They're not registered. They're not QSIP. And in a way, the stakeholders involved have never really needed to innovate. The providers of subscription documents and fund formation, the administration services, the people who have access to placement, and the folks investing do have a lot of capital and people. So you can keep throwing people at the problem. And so it's kind of stayed status quo for a long period of time. And so the frictions are kind of hidden. Like you said, it's like cleaning bathrooms. It's like, no one wants to do it, but someone does it every day, every month. And so that's what's been going on until they're offered an Uber or a Netflix or an Amazon. They're like, oh, wow, it fixed the problem. Now I have other problems to do it. But I think that the frictions are really there because we're victims of our own capital. We have enough of it to throw people at the problem.
Yeah, I think that makes sense. I think you don't really realize there's a better alternative to flagging a cab down in the rain until somebody comes along with an app that shows you a better way to do it. There's a lot of talk about, democratization of alternatives. I think you might have even coined that term back in the day. Where would you say, what stage are we at? I've heard you often say that we're beyond the democratization stage. Can you just talk to me a little bit about where we're at in terms of the evolutionary stage of alts and what the future holds?
Sure. I mean, I've always had an idea that the digital transformation of private markets is going to occur in 3 distinct phases, which is why I started my first company around democratization, which provided access to things that weren't available to wealth advisors in the US. My second company is actually stage 2, which is about infrastructure. Once you have democratization, meaning everything's accessible to everyone for the most part, if they really want it, it's packaged in the right way, which we're seeing with these semi-liquid products. It's kind of happened. And that's what I mean by democratization. It's not a thing that's happening. It's kind of happened, and now we have to deal with it. So dealing with it means, well, there's a lot more pressure on the system. There's a lot more buyers, a lot more sellers, a lot more service providers, and everything is paper-based. And so you really need new digital infrastructure to support this market. It never had an exchange. It never had the right pipes for scale. And so that's what we're doing with Subscribe, is we're rebuilding this industry infrastructure for the investor, for the fund manager, and for the service provider, so it can be seamlessly grown to scale. So that's really phase 2, which is the infrastructure build. And once that happens, what you find is that there's kind of this life cycle phase, which will be the next phase. Once everything trades at scale, everything's central, data standardized, processes are standardized, you can start doing more magical things in this asset class. So, phase 1, phase 2, and phase 3 are occurring. I think we're kind of in the maybe 5th to 7th inning of phase 2, and it'll be really exciting to get into that life cycle stage to see this really scale. But it's happening. You're seeing the regulators change some rules so more people can play. Packaging is definitely part of that. UMAs and portfolio bulk trade allocations are starting to happen.
So I've also heard you talk about alternatives in very equity-like terms too, in terms of pre-trade, trade, post-trade. So this is kind of describes where we're at in the current life cycle of alts, and that's. Can you talk to me a little bit more about that stage and how you see alts becoming more equity-like?
Yeah, so digital transformation and this second stage of infrastructure build is really focused around these three moments in time in the operational workflow. The pre-trade is the dating stage, the data rooms, the information, both the buyer and seller are trying to figure out if this is a right fit for them. The trade moment is about transactions, data on documents, signatures, AML, KYC, all the things that you do to get invested, all the things that you do to remain invested, the things that come up and that you have to change over the life of that investment. Sometimes it's open-ended hedge funds, which are short. Sometimes it's long-dated 10-year private equity funds and drawdown funds. And then there's the post-trade, which is really the management of reporting data. How is my investment doing? Where's my tax documents? Where are my PCAPs to show my values? And how does this all integrate into the larger ecosystem of systems? We talk about the family office and multifamily office and their full stack. Well, they have CRMs, they have reporting systems, they have other things that a tool like this needs to seamlessly integrate into upstream and downstream, which we do through open APIs and other mechanisms. It's really important you don't show up with a solution that has to sit on its own and becomes another swivel chair interface that someone has to deal with. So the move towards more equity-like is making sure that the pipes plug in upstream and downstream. Data flows seamlessly. There's a source of truth. And once you get that, I think what will come of these markets is more of a standardization in the underlying investment items in all these portfolios. It's very similar to QSIPing a security with a ticker that trades. I think you're going to start to see a real normalization of the instruments that are held by these funds, whether it's companies like SpaceX or it's a private credit or a private debt instrument on a company. I think those are going to start to be kind of categorized so that you can really start understanding what's in these portfolios and whether if you hold two funds that you might be holding a lot of the same assets. And then understand from there what you might be able to do in terms of a risk overlay or reducing your risk to any one sector. So that would be a future where these assets are much more equity-like. But it starts with the operational transaction data being harnessed and then bleeding into that investment layer and providing a standardization there.
That makes sense. I think to your point that you can't live on an island, right? You have to be able to integrate with the family office's tech stack. And if they have an Addepar, to be able to plug into that, or your other systems or CRM systems. Where do you see the future of alternatives going? Obviously, I think they're looking for broader distribution. You've mentioned some changes in terms of the qualified investor and being able to push that lower. Talk about it actually even having alternatives into a 401k. But where do you see where's the future of alts going?
Well, I think we're really seeing a lot of change. And if it all happens, it's a meaningful step because some of these things we've been talking about for a long time. Packaging alts to be in CITs, which would then go into 401k plans, increasing the amount of private equity or private investments a closed-end fund can have is that kind of comment recently from that we heard from the SEC. Rethinking the accreditation rules. How wealthy do you really need to be to invest in these products? Versus how much education should you have to invest in these products? I'm sure there's a balance there. Like I said before, excluding people from the private markets in today's market excludes them from a large part of the economic activity. And so you really need to reconcile that for today's market is you can't prevent people who are well-to-do and are earning and want to participate from participating in that. All they can buy is stocks and bonds. So that has to change. So all of this, plus the wrapping of a lot of these drawdown structures like private equity and secondaries and real estate in BDCs or REITs or semi-liquid products, both in the U.S. and what we're seeing now in Europe and other places, is the change that we're seeing. So definitely everyone's trying to make it more available and easier to use. The one thing I think about is that good returns don't come from size. There is still truth to the illiquidity premium. So if things are illiquid, you should expect a higher return. There's a reason for that return. If you make it more liquid, I think you should expect that your returns will be lower. It's only rational. I think at the same time, if you expand the capital that's being raised for any one opportunity, you should expect that the return will be lower. So there'll still be a room, especially for family offices and multifamily offices that tend to not invest with the major players all the time. They look for that top decile, smaller manager that'll remain hard to access, hopefully easy to do the subscriptions through us. But there'll be, I think, a real place for that, especially if something bad were to happen with some of these products and we get blowback. So I think we're in uncharted territory from a size and return perspective, and that's going to have an impact. So I keep my eye on that. But I think generally moving the market to where more people can participate is a positive thing.